Most companies need outside capital to scale and to grow. However, venture capital isn't always the best type of capital for a business. The cost of venture capital, the cost of equity is pretty high because not only are you taking on an outside investor, but because of what's called preferences, you will certainly learn that that investor becomes the priority as they're building out your business with you. So there's a concept when you're early on and you've got this great idea. You've got an idea to create some kind of AI security software, for example. And at the first stages of building that company, you're building a prototype. You're trying to figure out, you're doing research. You might still have your full-time job. The first phase of fundraising is often from a group of people that are called FFF, friends, family, and fools. And so what you tend to raise from them is they're angel investors or early angels, and you're raising $5, $10, $15, $20,000. Your goal is just to get enough space from your day job and or to pay the technology cost to build this thing. So that's the first phase. And those investors are investing simply because they like you and they can see themselves in you. From there, you move into seed phase. In seed phase, your goal is to further improve that product, further strengthen what's called your ICP, ideal customer profile, and to know what market segment you're going after. And at this phase, there are VCs. This is where VCs get really involved. And so I'll paint this picture later, but imagine a graph where over time and with work, risk in your company is going down. It's getting de-risked. Very high risk in the beginning, lower risk when you're ringing the NASDAQ bell and you're going public or you're over 100 million in revenue. The risk is going down. It goes down incrementally through this process. Also imagine at the front end of this process, the cost of capital and what you give to investors in exchange for capital is higher. So early on, you're giving away 15, 17, 20% of your company at these rounds. Later on, it's much less because you are de-risking the company, hence making the cost of capital less. Start to think about maybe how much equity you've given up already, and think about what happens if you need multiple rounds. What happens at the point at which you exit? I talked earlier about the 7 to 10 year process. Well, think about that as potentially 5 to 7 rounds of financing. Friends and family fools, pre-seed, seed, seed extension, Series A, B, C, D, mezzanine, possibly F in some cases, and then you go public. So there are going to be many bites at this apple. So be very conscious with whom you're sharing ownership in your company. I met Mike Tyson at one point. It's a very long story, but I spent a couple hours with him. And he told a story about the face tattoo and how he just had to lean into it. That's what creating ownership, co-ownership in your company is like. You're bringing in co-parents and you're literally putting a tattoo on your face because it never goes away. Whatever decisions you're making now about how to capitalize your company, you are going to see those decisions be borne out over time. It's important to be really mindful, incrementally investing and knowing why you're using that capital, because big valuations and big checks feel really good in the moment and they feed our ego and our love for our company. They make us feel great because people will write about us and you'll be in TechCrunch. But every decision that you make when you take in capital has a lifelong effect. And so overvaluing a company has a lifelong effect and could actually damage, if not kill, your startup. So be mindful. When I talk about founder to CEO, fire starter to fiduciary, you really start to see that change happening between your seed round and your Series A. The Series A is when you're bringing in professional investors in most cases. These are venture capitalists like myself who have institutional investors that expect a level of governance and a level of fiduciariness inside of a business. So that means predictability. That means legal structures. That means that you're a Delaware C Corp or what have you. You've got a cap table. You have quarterly financials. You're essentially running a real business. The goal of that Series A is so important because that is when you go from being a concept and an idea to something truly realized. That's when you're actually figuring out, how do I bring in, monetize, make successful, and remonetize my customers? So in that Series A stage, you are focusing on solidifying your product, building the infrastructure to run a managed business, right? You know what your gross margins are, you know what your cost of goods are, you have a P&L, a balance sheet, cash flow. You're running a business. You have employees, I imagine, at this point. You're also focusing on that go-to-market. Is this the right customer? Can I bring them in at a reasonable cost of acquisition? Can I monetize them? And can I, retain them and grow them over time? That's the critical piece of that Series A. The Series B now is about getting early scale. You're showing that for every dollar that I put into this business, I generate X amount of dollars in revenue. And so that's important, because at each of these stages, not only are you changing, your business changes, but the VCs are changing. The early VCs, they believe in you and in the market and the concept. The later stage growth VCs, they are looking at the fundamentals, and they're looking at the unit economics, and they're looking at the metrics. Read my book. I talk all about the metrics, but the key ones, I'm going to lay out kind of 5 here. So obviously, revenue and expenses and burn rates, all those are super important. But underneath that, you're tracking the elements. And I like to think about it in a really simplified way. There's someone in my family who sells candied apples, caramel apples. And so she sells those caramel apples for $18 each. And she might sell 1,000 of them. But at the end of the year, she hasn't made any money. Why is that? What is the cost of each apple? How much labor goes into that apple? How much does it cost me to transport that apple from my house to you, to wrap it, discounts, marketing, and all of that? The unit economic is what really powers a business. What is the cost for me to sell 1 unit of something? And so as you're building your business, you got to keep your mind on that and your eyes on it, because that's actually what creates line of sight to an efficient business, which is really what those B and C phases are about. One thing that your investors hate, and I'm going to talk about this a little bit later, investors hate surprises. They hate inconsistency. They want you to show up and do what you say you're going to do. I know one of the things I care a lot about when I'm investing in a company is, what is their say-do ratio? What do they say they're going to do, and what do they actually do? And most investors are tracking that. Series B is when you start to build out a leadership team that is actually capable of also being fiduciaries in your business. So it went from being you and this great idea, to you and this tiny product, to you and this tiny product and some people who believed in you, who would try it out and pay you a small amount for it, to now having a strategy to acquire great customers who can be profitable over time, to now Series B, you're managing the components and you're managing the elements that lead to an efficient, profitable business. At Series B, you should be able to see that big exit, that IPO, millions of customers, millions in revenue, because you know how to get there. And so the Series B is really when it goes from being just about you to being about your team, your finance folks, your head of sales, your head of marketing, your head of customer success. You're now surrounded by a professionalized group of other people who know how to help you grow this business. Now we're at Series C, and you've got growth investors who are momentum investors, who want to see efficiency, who want to see trust, who want to see consistency and patterns. And those later growth investors who come at your D and E and mezzanine phase, who are helping you go to market and helping you talk to masses of people, maybe IPO, maybe another form of an exit. But at that stage, that business is a fine-tuned machine. And all of it goes back to decisions that you made in the youngest part of that company. Remember a couple things. You're de-risking the business. You're changing your role from founder to CEO. You're leveraging executives and senior people. You're leveraging a board. And you are also becoming a partner to the market, your customers, and the people who are investing in your business. So choose wisely, don't surprise, and no face tattoos.